you revalue gold, you tie gold to the back end of the bond market so you have zero coupon, so you can, with a devalued dollar and zero interest rates, bring all that back. You have the stable coins running the front end. And Judy Shelton said, Andy, he's going to do this. Going to peg it to the Treasury, the back end, to the bond market on July 4th, 2026. So my theory, in a nutshell, is that because we realize what the BRICS are doing, they came out and said, we have agreed in principle to a gold-backed settlement currency. All they're doing now, instead of issuing the unit, because of all the heat on the BRICS, is trading in local currencies or building the rails for it and settling in gold. The unit will slide into that infrastructure at some point once it's fully matured. But I think someone in our administration said, you need to do this. It's happening in real time. If we don't reshore the gold, if we don't do these things, we're dead.
Gold is once again making headlines, and this time, the move isn't just about short-term market momentum. Spot prices have surged to $3,418.14 per troy ounce, closing in on June's all-time high of $3,448.50. After rebounding more than 3% from last week's low, the rally was fueled by labor data showing a far weaker U.S. job market than expected. But beneath the price action are deeper structural forces that Andy Schectman, president of Miles Franklin Precious Metals, believes could redefine the global monetary order. Schectman outlines a scenario in which the U.S. Treasury could revalue gold to $24,000 an ounce without congressional approval, simply by instructing the Federal Reserve. Such a move would effectively slash the dollar's value by around 60%, inject roughly $6 trillion into the Treasury, and hand central banks worldwide an enormous windfall. He argues this could be enough to revive U.S. manufacturing, secure strategic industries, and counter the deindustrialization that has plagued America for decades. With stablecoins managing short-term liquidity needs, the revaluation could also stabilize markets during the transition. However, Schectman stresses that time is running out. The BRICS alliance, now expanded beyond its original members to include major economies from the Middle East and Africa, is already laying the groundwork for a gold-backed settlement system. By enabling bilateral trade in local currencies and direct gold settlement, these nations are bypassing the US dollar entirely. In this video, we explore Andy Schectman's perspective on the rapidly shifting global monetary landscape, from the surging gold price to the BRICS nations' push for a gold-backed settlement currency. If you value deep, forward-looking analysis on precious metals, currency shifts, and global trade realignment, make sure to like this video and subscribe to the channel for more weekly insights. We appreciate the support and hope you enjoy the video.
So let's talk about gold revaluation for one moment. And is it a theory? Yeah, and it's not a conspiracy theory. As I mentioned, the Federal Reserve just put out a paper on it on their website, on the possibilities of it. Gold, in 1971, when Nixon closed the gold window, went back on our promise to the world, no, we're no longer going to give you your gold back for $35 an ounce. It was pegged at 35 at that point, closed. The next year in 72, he revalued the price of gold to $38, depreciating the dollar by 7 or 8%. The next year he did it to $42.22, devaluing the dollar again. That's where it stayed on our books since 1973, $42.22 an ounce. Now, if it were just simply mark to market, that would give the Treasury over 800, almost 900 billion free and clear. And the way that that works is the Treasury issues gold certificates to the Federal Reserve and gives the gold to, in essence, to the Fed, who holds it. The Fed prints money out of thin air and gives it to the Treasury. So in essence, it's an accounting gimmick. The Fed does not have claim on the gold, only on the cash value of it. The gold belongs to the American people. So $800 billion goes straight to the Treasury if it's market. Now, there are guys like James Rickards, who he's someone who's probably at VRIC every year. He is as smart as they come. He has spent years working with the CIA doing simulated financial war games, the Pentagon. He is a smart man. He's coming up with a number around, I believe, 24,000. There are lots that are, you got Mike Maloney saying 15,000. You got all these people with these numbers, and they get there by dividing M1 or M2 into the gold supply. However they get there, they get there. And you can go listen to Jim and find out how he got there. But if they moved it up to something like 24,000, as crazy as that sounds, first and foremost, the Treasury would not even need congressional approval to do this. they would just simply tell the Federal Reserve to revalue gold to $24,000 an ounce immediately. Now, that would benefit every central bank on the planet. They've all been loading up on gold for the last several years, every one of them. Not going to get a ton of pushback from the banks. The act of doing that would devalue the dollar by about 60%. The dollar gets way devalued. The price of gold goes to $24,000. Every $4,000 increase in the price of gold would give the Treasury general account $1 trillion free and clear. They get $6 trillion. That $6 trillion, they can start to pay down their debt. Now, what did Judy say? July 4th, 2026, they'll issue treasuries pegged to gold. Here's the key. How do you bring back manufacturing without rates going high enough because we are so far indebted? Well, you simply peg the back end of the bond market at a zero coupon, no interest rate, redeemable in gold. The more stupid we are with monetary and fiscal policy, gold acts as the inflation hedge and goes higher and higher and higher. It is the high interest rate. It allows us to have zero interest on the long end of the bond market, zero. And it allows us then to devalue the dollar massively. And that's exactly what you would have to do if you weren't the world reserve currency in order to attract demand for your manufacturing. So at a zero interest rate environment and a devalued dollar, you now can quickly bring home your manufacturing, start retooling it, bring home the weapons manufacturing or the aircraft parts or the pharmaceuticals, all the strategic, bring it all back. Bring it all back. You have a massively devalued dollar and you have zero borrowing costs, redeemable in gold, but zero borrowing costs on the back end. You bring back manufacturing, and now maybe you have a chance to grow yourself out of this problem. In an environment where the dollar has been way devalued and interest rates are zero on the long end, with the stablecoins running the government on the front end. And so when you talk about how do you get out of this problem, how do you bring back, if we don't bring back manufacturing, our children and our grandchildren are dead in the water. AI is going to kneecap so many white collar jobs, it's not even funny. And 60% of the country has no college degree, and we don't make anything. We need to bring it back. How do you bring it back in an environment where rates are too high and the dollar's too strong? You devalue the dollar, you revalue gold, you tie gold to the back end of the bond market so you have zero coupon, so you can, with a devalued dollar and zero interest rates, bring all that back. You have the stable coins running the front end. And Judy Shelton said, Andy, he's going to do this. He's going to peg it to the Treasury, the back end, to the bond market on July 4th, 2026. So my theory, in a nutshell, is that because we realize what the BRICS are doing, they came out and said, we have agreed in principle to a gold-backed settlement currency. All they're doing now, instead of issuing the unit, because of all the heat on the BRICS, is trading in local currencies or building the rails for it and settling in gold. The unit will slide into that infrastructure at some point once it's fully matured. But I think someone in our administration said, you need to do this. It's happening in real time. If we don't reshore the gold, if we don't do these things, we're dead. Well, I mean, that's really what it is for. I mean, you can, like, for example, the median price of a home was $232,500 in 2005, and gold was $445. So if we do the math and take 232.5, I'll show you this in real time, 232,500 divided by 445. 522 ounces of gold in 2005, you could have bought a house. Maybe you didn't do it. You took out a mortgage instead. Here we are 20 years later with that gold that you decided not to sell, the 522 ounces you left under your mattress, and which would have bought you a $240,000 house. Instead, you leave it under your mattress, earning nothing but dust, no interest. So the price of a house has gone up just under $200,000, right? And meaning that the dollar has, the price of real estate has increased, or your dollar has devalued or deflated against real estate. So it's been a good investment. But how about the 522 ounces of gold you left under your mattress times about $3,350? That's $1,750,000 divided by 410,000. Well, that buys you 4.5 houses right now. So my point is that as the dollar devalues and inflates, you go back to 1960 and do the same thing. A house was $17,000. I used to say this all the time. An ounce of gold was $35. That's 485 ounces, right? And that $17,000 today wouldn't even buy you furniture for your house. But the 485 ounces of gold, again, you're talking almost $2 million or $1.7 million or whatever, $1.5 million. And that's the point, is that the dollar continues to devalue, and gold, and this is going back 65 years. So that instead of selling your 485 ounces of gold in 1960, you pay $17,000 for a house. Today, those 485 ounces of gold buy you 3 houses. That's $17,000, doesn't even buy you the furniture. So this is the insidious devaluation of the dollar through inflation that slowly we don't realize.
While gold's role in global finance is under intense scrutiny, Andy Schectman sees the expansion of the Shanghai Gold Exchange into multi-jurisdictional vaults as a pivotal shift in the monetary order. Beginning with Hong Kong and now targeting Saudi Arabia, these vaults will enable nations to settle trade imbalances in gold using central bank digital currencies, thereby bypassing the US dollar entirely. For example, Saudi Arabia could sell oil to China, accept payment in digital yuan, and instantly convert it into gold stored in Hong Kong or domestically. China's planned vault in Saudi Arabia, viewed as the centerpiece of its overseas gold infrastructure, will directly link renminbi and gold flows, complementing deepening energy ties between the two nations. Schectman underscores the scale of this transformation. RMB settlement already makes up 15% of China-Saudi trade, with oil exports worth $58 billion annually. This structure could enable Saudi Arabia to convert a 30 billion renminbi surplus into gold, insulating it from dollar volatility. On the market side, physical demand is surging. Over 2 million ounces, worth $7 billion, were delivered on COMEX in just the first 3 days of August, an unheard of 1-to-1 delivery ratio. Since November, more than $100 billion in gold has entered the US, signaling aggressive accumulation by major players. Meanwhile, COMEX data shows speculators boosting long positions, even as silver, platinum, and palladium see minor price adjustments. Let's get back to the interview.
I think gold is becoming central to a new system. Call it the skeletal system of a new monetary order, whether it be in the BRICS or whether it be in the United States. Last year, the Bank of International Settlements pulled out of Project Enbridge at the 12th hour. They had been developing it with the Bank of International Settlements Innovation Hub with China, Hong Kong, Thailand, and the United Arab Emirates. And the Enbridge technology is a cross-border payment system that allows for instant settlement, 7 seconds, a 98% reduction in fees, cross-border between central bank digital currencies from country to country, free from SWIFT intervention. And the 5th participant in the Enbridge technology is Saudi Arabia. And things were progressing to the point where Dilma Rousseff, the former president of Brazil and the head of the New Development Bank, the BRICS New Development Bank, said, we've agreed in principle to a new settlement system called the unit. It is a digital representation of a basket of 60% BRICS plus currencies and 40% gold, deliverable upon request. And things were progressing, and you could see that gold was becoming central to their theme. And so what I'm getting at is that this system, which would compete with the SWIFT, will settle in 7 seconds, not the 3 to 5 days it would take these countries to go back and forth from dollars, from their currency to dollars and the other currency, and back and forth at a 98% reduction in fees. And they're going to open it to the remainder of the world. It's just not compatible with the pound, the euro, or the dollar. Subsequently, BRICS Pay is also being rolled out to the Belt Road Initiative, which is 75% of human population, 50% of global GDP. This is the cross-border business to business, consumer to business, small bank to small bank, the retail side of BRICS' agenda. Again, China is doing the central bank side. They're calling it the renminbi cross-border payment system, but it is the BRICS bridge. It is the Enbridge technology. But rather than antagonize the president, they're letting China do it first. The key to the third piece of this puzzle, the key to it all, at the same time, we get the expansion of the Shanghai Gold Exchange into multi-jurisdictional vaults around the Belt Road, starting with Hong Kong. The vault is complete. The next one is Saudi Arabia, which is under construction now. The idea between all of this is to allow countries to trade cross-border with one another in their own central bank digital currencies. We already have 16 countries officially signed up outside the BRICS, the Asian countries and the Middle Eastern countries, and to settle imbalances in gold through a series of multi-jurisdictional vaults, whether it be the expansion of the Shanghai Metals Exchange, Hong Kong, which is operational. And by the way, the yuan is immediately convertible into gold, not having to first convert to dollars as you would have in the past. So they're saying, okay, China will trade with Saudi Arabia. They'll send them digital yuan for their oil. Saudi Arabia can then immediately convert that into gold if they wish. Right now in Hong Kong, soon to be in their own country, in these vaults as they expand through the Belt Road, very ambitious endeavor, but ultimately connecting to a whole series of vaulting networks, whether it be in Moscow, in St. Petersburg, in Dubai, the new BRICS gold exchange, Shanghai, and the vaults that we see throughout the world. It enables these countries to trade locally in 7 seconds, boosting their own monetary infrastructure, free from SWIFT intervention, and settle any and all imbalances in gold. It's genius. It truly is. And I really hammered this home over the last month. And then yesterday we get an article, or 2 days ago, from Forbes that pointed out that China is now just the third largest trading partner for the United States. And in May, their numbers were less than 6% of trade, which is the lowest level, Daryl, in over 20 years. And the article went on to say that the Asian countries, these same countries that are now hooked up and actually in operation with the new bridge technology, together have a population twice as large as the United States, over 700 million people. They have the fastest growing consumer markets in the world, the fastest growing middle class in the world. And as a group, get this, these countries are now China's largest trading partner by far, way ahead of the EU and the United States. Let me just say that once again. They're connected, and they're the largest trading partner of of China, and they can trade cross-border in 7 seconds with no SWIFT interference, no SWIFT recognition. They won't know what's going on, and any imbalances will be able to be settled immediately in gold. This is a massive deal for the BRICS. All right, so that more or less covers the BRICS side of things, where you have, in essence, an expansion of the Shanghai Metals Exchange, connecting with other metals exchanges already in operation in Dubai and in Moscow, the new one that just was built in St. Petersburg. And the ambitious goal over the next year or two is to create this skeletal system of vaults, multi-jurisdictional, so it's not all held in one location like the Bank of England, who had the power to say to Venezuela, yeah, we're not going to give you your gold, thanks anyway, move along. And I think there are those in the Trump administration who understand this. Because since November, Daryl, we have become by far the largest importer of gold in the world. We have never been a net importer of gold in the world, maybe since World War II, after World War II, when everyone sent us their gold as part of the Bretton Woods Agreement in order to have the dollar pegged by gold. And we said to the world, hey, you give us your gold and we will give you $35 for it. With those $35, you should buy our treasuries, earn interest on your gold. We'll save it and keep it in safekeeping instead of the war-torn, 2 World War ravaged Europe. You'll keep it here with us. We'll keep it safe. You can always exchange your gold that you have back to us for $35 an ounce. So instead of keeping it there where it may not be safe, give it to us. You'll earn interest on it. You'll help us, and we'll always exchange the dollars you have at $35 an ounce. So, what's happening in the United States is absolutely insane, to be honest with you. In fact, I've never even begun to see anything like it ever. And if we realize that month over month over month over month since November, we've seen massive amounts of gold come into the United States, and no one is really talking about it on the mainstream at all. And what does it mean? This is a very big deal. When we look, as an example, just to give you an idea of how big it has been, every single month we've seen massive deliveries, massive. And, most of my career, less than 1% of contracts that are issued on COMEX stand for delivery. In the first 3 days of this August gold contract that just hit the board, 20,126 contracts of gold at 100 ounces apiece stood for delivery. Now, the interesting thing about that, remember I said only 1%. What is really interesting is that not only and by the way, that's over 2 million ounces of gold, right? You're talking almost $7 billion worth of gold. Every single contract that was issued in the first 3 days has settled for physical metal. That's 100% a one-to-one ratio. This means physical delivery is actually taking place, not just speculative paper settlement. You're talking 2,012,600 ounces of gold in 3 business days. Now, there's going to be a lot more that settles. We'll see how much more it truly is. But we have seen north of $100 billion worth of gold come into this country since the beginning of the year or since November. And that's just what we know of. I'm sure there's a lot more coming in, not through the COMEX, through proxy banks, through other channels where reporting it isn't as obvious or a necessity. And who is buying it is the question. Who has the money to stand in 3 days for $7 billion worth of gold here in this country when that's never happened before? This is 4 feet of snow in Death Valley in July. It doesn't happen, but it is happening. And it's happened every month since November, since Trump was elected. Bigger almost every single month. And August is not a primary delivery month. And yet you're seeing $7 billion worth of gold stand for delivery. 100% of the contracts issued. No, we don't want cash. Thank you, Daryl. We'll stand for our metal. Something significant, hugely significant, is happening with gold.
Andy Schectman outlines a structural transformation in the global financial system as precious metals reclaim a central role in settlement and trade. Emerging economic alliances and major powers are developing mechanisms based on tangible assets rather than fiat currency. The strategic expansion of international vault networks in key trade hubs is enabling direct settlement for critical resources, thereby bypassing conventional currency conversion channels. Simultaneously, futures exchanges are witnessing extraordinary withdrawal rates, with physical inventory leaving the system at a pace rarely seen. This trend suggests a deliberate consolidation of supply by entities anticipating fundamental changes in how value is stored and exchanged. Schectman emphasizes that the real contest lies in controlling the flow of metal that will anchor the new framework. Those who act during this transitional window may secure a lasting advantage. But once the architecture is entirely in place, the chance to position effectively could disappear almost instantly. What happens when the world's trade settlements no longer need the US dollar, and gold once again becomes the foundation of global finance? If you found this breakdown valuable, please like the video, subscribe, and share it with other serious investors who need to hear this. We'll continue to bring you the brightest minds in the markets and the insights to stay ahead of the storm. Thanks for watching.